Weekly stock market update, friends, and we have had interest rate cuts and we've had election fever in the US. These two things are the predominant things which are going to be moving the markets. So let's have a look at them in detail. Remember, as ever, this is not individual financial advice. Markets can fall and fall further, even though they're currently at all-time highs. This is information and education for you. That is an image of one of my forthcoming books. So, how does it look after the first rate cut? Well, there's been a 50 basis point cut. It is the 18th of September as I broadcast this. And these might be the sectors where, all other things being equal, we're going to make the most money. That's not to say there won't be things in finance. I continue holding JP Morgan and Goldman Sachs, and they're doing rather well, thank you very much. And so are some of the energy and utilities, and we'll dive a bit deeper into those specific stocks. That's why I don't like these generalities, because making money is about specifics. S&P 500 returns after rate cuts. Well, they look pretty good after the first year of rate cuts. We want to try and get our hands on some of these 30% gains, 36%, 10% even, 27%, 14%. It's pretty good. The first 3 months might not look so great, particularly in an election year, but when you take the 1 year outlook, which I tend to do, things start looking a lot more attractive, a case for holding your nerve. By the way, if you'd like a free copy of this book, it is at alpeshpatel.com/links. I've had a great review from a $2 billion hedge fund manager. Actually, I think he's running 4 now, from Bloomberg TV, Financial Times columnist as well. Great book. Get it for free, alpeshpatel.com/links. Also, you'll be able to get this completely for free, my Financial Times published internet trading course, the complete course in online investment, completely for free from the same link, alpeshpatel.com/links. Now, what I'm going to tell you in this stock market update is all my information from my, 200 columns in the Financial Times, as well as from my books and from being a hedge fund manager as well. So you're going to get all of that information. You can see my bio up there as well. So if you want to read that, you can see there's quite a bit of experience and expertise that goes into this. Where are we in terms of valuations? Now, valuations are not the only things that move stock prices. They're important, but they're not the only thing that move stock prices. And for that reason, I don't get overly excited when, I'll move myself over so you can have a look, when Microsoft is 28. You're paying $28 for every $1 of expected profits in Microsoft, or that's 29. And I don't just plow into energy. If valuation was the only measure, then we would only be buying the ones in green and selling everything in red. Clearly, most of the returns have come from the ones in red and not the ones in green, which reinforces the point. Whilst valuation might be important, it's not the only factor that moves stock prices. Growth, for instance, does as well. And so that's why we look at all these factors. What could move markets? Well, interest rates and the decision to reduce them by 0.5% is the critical factor. Beyond that, none of these are really going to be moving markets. So those earnings that are coming out after market close or before market open are not going to be moving the markets. Excuse how I sound. I've got a terrible cold. Please don't forget to like, comment, share, subscribe. Even if your comment is a thumbs up or great, because it makes sure that more people share this. As I mentioned, the only factor that moves stock prices isn't just valuation. That's why we have to tick the value box, though we weight that at about 50% weighting. Growth and income as well have to be weighted. Across 10,000 stocks, I will weight this. This is probably the most important factor because it is ticking those boxes on valuation, on growth, on income. On income, we're looking at dividend yields. We're also looking at growing cash flows. We're looking at, on growth, growing profits, growing revenues. Valuation, I guess, becomes the most complicated because do you look at future profit forecasts? Do you look at historic? Do you look at relative? Do you look at absolute terms? Do you look at price, the share price compared to the profits the company generates, compared to the sales it generates, compared to the book value? In other words, if you sold the company in a fire sale, or in discount cash flow, all of those factors are various different measures of valuation, and they all have something going for them. Do you use enterprise value? Do you use for earnings EBITDA? So is it price over EBITDA? The academic research that we've looked into informs us on that value factor. Okay, value, growth, income, incredibly important. Without that, you cannot narrow down 10,000 companies. If you can't narrow down 10,000, you're going to be throwing darts at a dartboard, and you're taking risk. If you're taking risk because you're ill-informed, you don't have the information, then you're gambling. Cash return on capital invested comes from Goldman Sachs Wealth Management. Again, incredibly important. Companies in the top quartile generate 30% per annum. Not every company in the top quartile will generate that, and not every year. But in the good years, it makes up for the bad years, but there are big variances. So it is important. Momentum comes from the hedge fund industry. Sortino and Alpha, very important in terms of statistical analysis. You all want stocks which have a high average historic return with very little downside drawdowns and quick recoveries. And when the markets are going up, you want yours to go up even more. When the markets are falling, you still want yours to go up more than the markets. That's what's statistically captured there, though history is no guarantee of the future. That's why my spreadsheet of 10,000 looks at those factors as a narrowing down, and then uses my own expertise and experience, particularly with momentum, to narrow those stocks down. So you can't just simply replicate a spreadsheet and hope to get the same answers, because you can't replicate human experience and expertise for a start. Okay, so let's go into, some of these over the past week. A ton of green. Okay, so markets have been pretty good over the past week. Over the past year, even more green. And that's rather good. We want to be in a position, when we can't guarantee what the future looks like, we want to be in a position to be getting as many of these as possible. How do we do that? Well, if the markets generally go up and there's a tailwind, it makes life a hell of a lot easier. Everybody looks smart. When the markets are rising, all boats rise. It's been rising. Our job, therefore, is at those years not to mess it up. In other words, not to trade our investments and not to be looking in the opposite direction. In other words, we need to be able to capture those opportunities. Sadly, too many people with their pensions do not capture these opportunities, do not capture the 33% and the 57% and the 30s and the 23s and the 31s. They rely on fund managers to do it for them, and the fund managers mess it up very simply because the fund managers will put too little in. And why will they put too little in? Because their mandate dictates it, because they've been told on a risk management basis that they're not to have more than, say, 5% in any particular stock, or even 3 or 4. And so the few big giants that win, they don't have enough money in them, time and time again, and that's why your portfolio underperforms. It's one of several reasons. Exchange traded funds, index trackers as it were, that's what they've looked like over the past month. I will do a separate video on these. Where are we on markets year to date? I'm going to make myself even smaller. Okay, markets year to date. Now, the funny thing about markets is this. If you started around February, March time, you got pretty much a 0% return until a couple of weeks ago. Okay, so as I remind you, even if you've got 18% up in your pension this year, or your NASDAQ, or your pension track, just even the NASDAQ, and you're up only 15%, let alone if you cherry pick and do a bit better, but let's say you didn't. Okay, that will be composed of upward movements, periods where your gains all went back to zero, periods where you just lost money, okay, and periods where you got 0% returns, prolonged periods of 0% returns. You can see them, there's many of them. So 3 out of 4 times you're not happy with what's happening in the market. That's just how it is. Even in a year where it goes up 18%. Okay, which are the sectors? Well, they've all gone up, but I don't look top down because I don't try and gamble which horse is going to win the race, because for a long time, if you did that, you would have said, oh, well, definitely don't want to be in real estate. And then, of course, it catches up and gives you a 14% return. So if this looks random, it's because it is gambling if you're going to try and gamble on sectors. You can invest that way, some people do. I choose not to gamble. I like to look at individual companies. If they then happen to be in utilities, so be it. Okay? What about factors? Watch factors. Well, the factors which have led to all of these rising have been momentum, value, and growth. As you can see here, they've been the top 3 factors. So if you were a momentum, value, or growth company in utilities, you did rather well. So that is why when we're looking at stock picking, we are looking at companies which tick all of those boxes and fit in a subset of a subset of a subset. In other words, they're growth companies, they're value companies, they're income companies, and so on. That way, whichever one of these does well in the markets, we must have been in it because we only picked a subset of a subset. That's why we need 10,000 stocks to filter through to begin with. Okay, it's very simple, it's logic in that regard. Markets over the past year, well, the Nasdaq's up 27%. Okay, however, as I mentioned, there will be prolonged periods of, say, 0%. The job of a pension, a SIP or an ISA, for those who haven't worked it out, is to replicate yourself. Replicate yourself so that when you retired and you're not earning an income, the pension is earning the income for you. And if you use the rule of thumb of withdrawing 4% per annum from the pension, if the pension grows more than 4%, you're doing rather well because you're not even eating it really into capital aligned for inflation. However, it won't move like this in the markets. What will happen is you will have 2022 a 0% year, then you get 2023 a 55% up in the Nasdaq, then you get a 2024 27% up, and then you might get another year like 2022 where you're 0% up. In other words, it goes not like this, but in a stepped manner. And we've had another step up this year. We don't know at the start of the year whether we're going to get a massive jump up. But those jumps up can be prolonged periods of 0% returns. If you're not even in a position as a UK pensioner, SIP or ISA holder to even know how to access a NASDAQ or an S&P 500 stock, then you're going to end up with a piss poor performance of what happens with UK fund managers who will not access the fastest growing, highest growing companies which are the most undervalued. Okay? FTSE 350, 350 largest UK companies over the past month. These are the performance of the biggest ones. Okay. One of my students had bought Centamine. It had a takeover bid. I told them if it were me, then I'd exit because you've had your gain and a nice one at that. S&P 500, as you can see, the monthly MACD is moving up still. So the market is a little bit like September 2021. It's a bit like this. Now, that could easily be resistance, and the market now just falls off until November and the general election because we've got a 0.5% interest rate cut. So that's in there. Probably won't get another one till January. There's an uncertain election coming on, so why wouldn't it drop? I'm not saying it's going to. I'm saying that gives us more of a case for that. I only exit if it's a daddy bear, which means if the MACD falls below its own moving average from up here. Now, at the moment, it's still rising, so I'm not worried. I continue holding my S&P. Would I buy more today, S&P? Probably not. Why am I continue holding it? Well, because I've had it since January 2023 when it was down here. So I've got a big endowment buffer of lots and lots of gains. Look at that, by the way. September does tend to be a bad month for the S&P. NASDAQ, similarly, it's rising. It looks like it did over here in terms of momentum. This, by the way, is a 1 month MACD. This is a free resource for you if you want to use it. I'm not affiliated or connected to any of them. And as you can see here, it's maybe got one more rise to go before it drops off. Maybe it's going to go back here before it drops off, or it might drop. So if you're risk averse, you might get out. If you're more risk neutral to risk loving, like me, you'd just stay in and wait. I continue holding it. It's easy for me to say I'm holding it because we've had it since 2023. FTSE 100 index is, well, it seems to have peaked and looks like it's running possibly out of steam. Looks like it was around here. So there's a danger it could drop off. The top 10 S&P 500 stocks over the past month, this is how much they've moved. Let's have a look at these and make sure we're not missing anything in terms of opportunities. eBay, by the way, was already in my September further filtered list. So those who are on my program will have seen it. I want to have a particular look at Oracle for you as well in this. So GE Vernova, whilst all these people love it, sorry, not enough data for me. Some of you want to take a deeper dive in it and think it's going to rocket up. That's up for you, but we don't invest in stuff where we don't have more data. That's too little data for us. United Airlines is a 7 on the value growth income. But this just looks too erratic and it's been going sideways. So personally, unless it broke above there, unless it hit about 60, I know all these other banks love it. Unless it hit a 60, I'd still be waiting, because look at these volatile drops. So not for me. Norwegian Cruise Lines, another 7 value growth income. But again, similar kind of story. It's sort of a bit overbought here. Who's to say it won't go up there? But that's pretty speculative and high risk. Not for me. Oracle, now big name. It's an 8. As I said before, Oracle you would buy if you felt, as I've said, on the basis that when the MACD is broken to the upside on a high, 20% of the time, companies like Nvidia and Oracle may well possibly keep going up and up and up like this 20% of the time. And that 20% has to make up for the other 80% where they don't do that. So you've got to make sure, you've got to be pretty confident that's going to keep going up like that. So can that go from 167 to about 500? All right, well, we know it can go from 50, we know it can triple over 4 years. Can it triple again? That's really what would have to justify buying into this now. Value growth income, great, but buying something that overbought, you'd have to be confident that on a trajectory forward, that can triple in the next 2 years. Okay, I think that's what would have to justify your risk on it. Otherwise, in the short term, too overbought. Solventum, not enough information. Sorry, not for me. Speculative crazy. Insulet, 7, I think we've added on our further filtered list previously, and looks like a good special situation for us. In other words, value growth income 7, 8, 9, and that is moving in the right direction. What I would tell my students on the program, and I know this is a public broadcast, and they'll be well aware, is they will determine whether or not the reward, which is a projection forward of this over the next 12 months, will that give them a 40% return, because that's the buffer they need, and is the risk worth it? So reward versus risk. In other words, can they take and stomach some of these drawdowns that it can have on upward trends? Now, students know what I'm talking about here. So that's really the decision to be made on Insulet. Builder's first source isn't 7, 8, 9 or 10. Moves up nicely though. And it's a bit overbought. So not one for me, whilst I do take notice. All these people seem to love it. eBay. Now that was on our September further filtered list. It's at a 7. Again, my students will know how to evaluate this. They will know projection forward, 40% over 12 months or not, and can they take the volatility, okay, on an upward trend that it's historically had, on the assumption they will get the same drawdown depth and duration that's happened before. Carnival misses the numbers there anyway, and you can see a bit like that other cruise liner. Best Buy, well, misses the value growth income, though on a pure momentum play, you might want to do it. You know when people say take a punt? It's up to you. I don't take punts. I don't risk. If I want to do that, I'd go to Vegas. So not for me. And as I said, in future, this will one day be yet again, when the pattern looks more like this, which it will in maybe a year or two, we'll be back in it and we'll double our money on it, okay, in our pension. Apple, I continue holding. Would I buy more? Looks a bit overbought. If you put a gun to my head, I'd buy it on the basis it's Apple and it's one of my quality 5 plus. But for the risk averse, you wouldn't buy it at these levels. You'd just wait, I think. Similarly with Amazon, similarly with Microsoft, similarly with Meta. In other words, if you already own, you'd hold. If not, you'd say a bit overbought, might wait. Bank of America, has it got legs to get up there? Because it's a bit like it was here. So be warned, it might replicate this movement here, and that might be more risk than you want to take for the return. You might say the return is not worth, the reward is not worth the risk journey. Netflix, I've mentioned this week in, week out. I won't say any more other than for those who got in from that period when I started covering it in, December or August of last year, so 12 months coming up, and you've doubled your money, well done. And you saw exactly why I said it before, because it was a 7, 8 or 9 and the momentum was rising quite strongly. Okay, very simple. 8 on Walmart, bit overbought, but again, if you wanted to do it the way with Oracle, it's moving, broken above its previous high MACD sharply, and the risk you've got is more often than not, it can drop back. So you might as well, how do I risk mitigate that? Well, you could put a smaller position size in and then add to it, your full position size, as you build up profits. So you add to your winners, okay, is one way to do it. Berkshire Hathaway, a bit overbought, but again, could be justified on the other basis of it's moving upwards. However, it's not 7, 8 or 9, so probably a bit more than I want. Eli Lilly, same as the last one. Great. We will come back into this one day when the pattern goes back down to this, and we will once again maybe triple our money in this. We will come back to Eli Lilly. It's just right now, the only justification for buying it would have been that it broke its previous MACD high at a sharp inclination. And that's what I'm talking about. When it does that, and if you were to get in at this point, then you'd have to have projected it forward on the basis that you can triple your money in a year or two. And if you couldn't see that, we didn't get in there, by the way, then you wouldn't get in, okay, just because it's overbought. And certainly now, you'd be saying, oh, okay, not really. So has this bottomed out? Looks like the mama bear hasn't crossed below, so might be at long last sort of going in that direction. Barclays, well, a whole bunch of banks in August said buy. CVS Health seems to have sort of flattened out a bit, so that's good. Block flattened out a bit. Don't forget to look at LinkedIn. I am what they call a top voice, okay, on there, and look at my campaign for $1million.com to teach 1 million people how to be better investors. Thank you very much. Don't forget to like and follow, and for those free books, alpeshpatel.com/links. Oh, I've got more stuff for you. Of course I have. FTSE All Share, S&P and NASDAQ. This is one of the reasons why I'm speaking to you from a day when when the S&P set an all-time high. 600% up since 2008. NASDAQ 300% up. FTSE under 50% up. And if your pensions did that, well, which would you prefer? And so I've always preferred the US markets because they get more choice and more growth. So why do fund managers underperform all the time? And really the critical reasons are, of course, they make poor investment decisions, is one reason. But let's say you say, no, I don't believe it, they're experts, they're God's gift to market insight. Well, they don't put enough money in cash when they should, like 2022, because they're not allowed to. So that's the other reason. Lack market insight. Well, remember, these are people who, after 5 o'clock, they're off to bed, aren't they? And sort of, they don't live and breathe this the way hedge fund managers such as myself love and breathe the markets. They're sort of like what a GP is to a brain surgeon. Inadequate performance reviews could be one. There's no downside for failing. If they fail, they still get paid lots and lots of money. Okay, the board of directors are not fund managers, and therefore there isn't the accountability. They never speak to an investor. But on top of that, if they bring in more money, they get more pay. Not based on performance, based on how much advertising potential they have, because they're paid fees based on the capital and assets under management. They report once a month, whereas if you hold your own money, it's a hell of a lot easier. And my mission is to teach people how to manage their own pension and their own SIPs and ISAs, and it's a hell of a lot easier than people think. Okay? By the way, we looked at presidencies in the last 10 years, $100,000. If you invested it, whoever was the president, it would become 311. If you only did it when it was Republicans, 181, only when it was Democrats, 172. Bottom line, doesn't matter who's the president. Performance of US stocks during election versus non-election years, US stocks across election cycles. Okay, all years 10.3%, presidential election years 11.6%, midterms that doesn't apply right now. US stocks plus 26.3% in 2023. Non-election years, odd years, no midterms or election is 14.8%. CO, it should be a bit lower, but it is 26% at the moment. Okay, US stocks have tended to lose money less often in election years. Right? When did they make money? US stock performance in election years. You rarely lose money in an election year, is what the message there is. And here you can see all the elections since 1928. If it's an election year, you should probably have doubled down the start of it. Okay? Avoid this problem. This happens, this is taken from my book, which you can download for free on alpeshpatel.com/links. Avoid this problem, because this is what happened to a lot of people in August. They got out of tech stocks. Well, first of all, they got in too late, and then they got out when they panicked, and then, of course, they went back up. How do we avoid that? Well, I think what I've shown you in terms of baby bear, mummy bear, and daddy bear is probably the easiest, most objective way I've learned. And I learned that from the research reports of 3 Nobel Prize winners, Daniel Kahneman, Eugene Vermeer, and Richard Thaler. Because essentially the bottom line, if you combine all their literature, or one of the bottom lines, was you need to avoid the biases, the cognitive biases and the narratives, and the stories you tell yourself. And that's why the most important way I found of doing that was looking at the moving average momentum of the stocks. By the way, where do wealthy, younger and older investors see greatest potential for growth? Ages 21 to 43 and ages 44 plus. Well, domestic equities, this is an American audience who asked this by a Bank of America private bank, the private banking arm. I like to share with you private banking information because it tends to be a bit more exclusive, doesn't it? So domestic equities, unless you're young, in which case you think real estate, which is interesting, in crypto and digital assets. But yeah, if you're older, it's US equities. So there we go. What might happen now? This could well happen. Where about here, we hit an all-time high, and then until after the election, we drop off, and then we go back up again. Okay? One of the reasons why I've said the US makes my life easier in my SIP and ISA, and I wrote about this back in 1999 in my Financial Times column, so 25 years ago, compared to where we are now, UK pension funds allocation to British stocks have hit a historic low. It took them 25 years for everybody else to realise what I've been telling them. This is why I want you to manage your own SIP and ISA. Have a look at alpeshpatel.com/links if you want to learn more on how to do these things. One of the biggest problems that I answer for people is those who don't know what to buy and they face a problem like this. We'll talk about that in the future, but I hope you enjoyed the stock market update. And as I said, if you look at, there we go, alpeshpatel.com/links, you'll find a lot of the free material there. Thank you very much.